When OPEC Plus decided to unwind 2.2 million barrels per day of voluntary production restrictions later this year, the oil markets reacted badly 2 weeks ago, sending oil prices plunging to multi-month lows. According to Standard Chartered, the sell-off was an overreaction brought on by a number of variables, such as excessively pessimistic macroeconomic forecasts, speculative short positions, and overly enthusiastic algorithmic trading that drove out more fundamentally based traders. Fortunately, oil prices have mostly returned to where they were prior to the OPEC Plus announcement. However, StanChart predicts that the second half of the year will likely witness substantial deficits in the oil markets. However, not everyone is that optimistic. According to Citi, there will probably be a sell-off in energy stocks in the fourth quarter, and the oil market would see continuous builds from Q4 2024 onwards, but small inventory draws in Q3 2024. According to Citi, in 2025, non-OPEC supply growth will outpace global demand growth, and the approaching US presidential election might act as a bearish catalyst. The International Energy Agency generally shares Citi's pessimistic projections. The Paris-based energy watchdog, in its June 12 oil market report, OMR, stated that the growth of the world's oil demand will continue to slow down, with 2024 growth estimated to be 960,000 barrels per day, 100,000 barrels per day less than its May forecast. The IEA reports that a seasonal spike in Brazilian ethanol production was mostly responsible for the world oil supply's 520,000 barrels per day increase to 102.5 million barrels per day in May. The International Energy Agency, IEA, projects that world oil production would rise by 690,000 barrels per day this year, with a 1.4 million barrels per day gain from non-OPEC Plus sources partially offsetting a 740,000 barrels per day decline from OPEC Plus sources if voluntary restrictions are kept in place. According to IEA forecasts, non-OPEC Plus output is expected to climb by 1.5 million barrels per day in 2025. While world supply is expected to rise at an even faster rate of 1.8 million barrels per day. The IEA has released its yearly medium-term oil market report, which includes projections for 2029 and 2030. The Oil 2024 report from the International Energy Agency, IEA, looks at the global dynamics of trade, investment, refining, and security of the oil supply. It was just issued. The prediction in the paper that oil production will reach a staggering 8 million barrels per day above projected global demand by 2030 attracted a lot of media attention. The paper highlights China's lowering oil consumption growth, the spread of electric vehicles, and the increasing use of renewable energy sources as major drivers of this anticipated trend. But the IEA continues to predict rising oil demand. The International Energy Agency, IEA, projects that global demand would rise from a base of 103.2 million barrels per day, BPD, in 2024 to 105.6 million BPD by 2029 and then slightly decline to 105.5 million BPD in 2030, Table 2 in the study. Non-OPEC Plus nations, including the United States, Brazil, Guyana, and Canada, are predicted to pump at record levels, which will be a major factor in supply increase. By 2030, it is expected that non-OPEC Plus nations will contribute 6 million BPD to the supply. On the other hand, it is anticipated that OPEC Plus output would stay mostly constant, with voluntary production cuts playing a big role in preserving market stability. The mismatch is expected to have significant effects on geopolitics and could reduce OPEC's ability to control oil prices. The IEA uses projects that have been announced as a basis for some of its supply estimates. The IEA must, however, also make assumptions about future discoveries, demand trends, and depletion in already existing resources in order to estimate a supply excess. Similar predictions were made by Bloomberg in their 2016 article Another Oil Crash is Coming, and there may be no recovery. If that level of growth continues, the crash-triggering benchmark of 2 million barrels of reduced demand could come as early as 2023, the article stated after examining patterns in the sales of electric vehicles. I disagreed with the presumptions stated in the Bloomberg article and came to the following conclusion. Therefore, it should not come as a surprise in 2023 to discover that, contrary to what the Bloomberg story claimed, crude oil demand increased despite the continuous rise in the number of electric vehicles. That's exactly what took place. As we all know, oil prices in 2023 most definitely did not indicate an oversupply, and global oil demand in 2023 was around 5 million BPD greater than it was in 2016, the year Bloomberg made the projection. But imagine the potential consequences if the markets had accepted the Bloomberg estimates at their value. In 2023, oil prices may have averaged $130 to $150 per barrel as supply failed to meet demand, rather than $78 per barrel if investments in oil projects had stopped up due to the anticipated supply excess. Misleading forecasts may lead to volatile prices. In the end, as Bloomberg discovered, these estimates are difficult to make. In 2005, energy specialists worldwide would have laughed if you had projected that US oil production would rise at the quickest rate of any nation during the ensuing 10 years. But that's precisely what took place. I'm not sure if the IEA forecast turns out to be correct. I am aware that, despite remaining close to record levels, US oil output has leveled off during the last 10 months. The majority of the US's top tight oil locations have already been drilled. Although the IEA predicts an additional 2 million BPD of increase in the US by 2030, it appears that US oil production may be approaching a plateau. The IEA's prediction is predicated on a number of factors. The IEA's predictions of a staggering excess might be wildly inaccurate if just one or two of those presumptions were incorrect. In response to claims of industry and OPEC conspiracy to raise oil prices through production constraints, the U.S. Senate Budget Committee has opened an investigation into nearly 20 major producers of gas and oil. Senator Sheldon Whitehouse's assertions echoed accusations earlier this year from the Federal Trade Commission against Scott Sheffield, the former CEO of Pioneer Natural Resources. The Federal Trade Commission, FTC, claimed that Sheffield had conspired with members of OPEC and OPEC Plus to restrict output and drive up oil prices in the wake of Exxon's acquisition of Pioneer. The claims rocked the shale oil industry, as the trade watchdog was still deliberating over a number of sizable consolidation deals. Pioneer founder and former CEO Scott D. Sheffield has advocated for anti-competitive coordinated output reductions between and among U.S. crude oil producers, and others, including the Organization of Petroleum Exporting Countries OPEC, and a related cartel of other oil-producing countries known as OPEC+, the Federal Trade Commission said in a formal complaint filed in May. Sheffield has done this through both public and private statements. The FTC's accusation against Sheffield, which he swiftly refuted, was dubbed revelations by the Senate, which also threatened to seek answers from 18 businesses on any attempts to coordinate production policies with OPEC members. Aside from Exxon, the businesses under investigation are BP, Shell, ConocoPhillips, Chesapeake Energy, Continental Resources, AOG Resources, Hess, Marathon, Occidental, Ovintiv, and APA Corporation. 16 of the businesses the investigation is looking into are in the process of merging or buying another company. The companies have been asked to provide communications between any staff members and OPEC representatives about oil production output, crude oil prices, and the relationship between the production and pricing of oil products, dating from January 1, 2020 through the present, according to a request made by the Senate Budget Committee. Additionally, the committee has asked for details regarding any correspondence with producers in OPEC+.